Welcome to our third quarter fund manager report. My name's Harry Thompson and I'm a portfolio manager at King & Shatton. This slideshow will take a look back at some of the events that happened in the previous quarter up to September 2021. A text version is also available via the news and views section of the website. As we enter the last quarter of 2021, the world is approaching the second anniversary of the pandemic. From a period of economic recovery in late 2019, what followed was an unimaginable sequence of global events that are still playing out today in society, the global economy, and the global ecosystem. The human death tolls of what's happened has been immense. Millions of lives have been lost and many more affected, not only directly by the virus, but also through lockdowns and the social and economic consequences of what's happened. The UK, as well as other developed nations, responded with various forms of lockdowns alongside unprecedented monetary and fiscal stimulus to mitigate the economic impact of a global pandemic. To enable this, a great deal of government and government-backed debt has been taken on, with central banks' balance sheets expanding to levels that far exceed that of the 2008 financial crisis. These actions have certainly prevented a serious and dangerous economic depression. Since the depth of the crisis in 2020, access to vaccines, particularly in countries such as the UK, paved the way towards a normalisation back to pre-pandemic life. Many other parts of the world have been less fortunate and are still struggling with the virus and its social and economic consequences. In response, global equity markets have reacted. Equity markets, which were falling sharply in the first half of 2020, have recovered strongly. Some 20 months on, many global equity market indices are much higher, depending upon their constituent stocks. Initially, technology-focused companies excelled during lockdown, as digitalisation accelerated. On top of this, more future-focused companies also benefited. This included many significant impact investments, whilst the older, cyclical companies such as oil and gas, tourism and airlines suffered as the global economy slowed. In 2021, global equity markets continued to rise as cyclical investments caught up with the growth investments, and the governments and central banks continued with their aggressive stimulus. Global markets found themselves in the classic Goldilocks scenario, with a growing economy and cheap and abundant money. So what do we mean by the Goldilocks scenario? As in the story of Goldilocks, the three bears do eventually arrive, this time in the form of inflation, supply constraints, and the post-COVID world. However, unlike in the story, fleeing the scene is not a viable option. Global markets, businesses and society are going to have to address how they adapt to these changes. Traditionally, inflation is regarded as the consequence of too much money chasing too few goods and services. During the financial crisis of 2008, we saw a sharp rise in the quantity of money, which, as explained by the Fisher equation, was not accompanied by inflation due to a collapse in the velocity of money. Advanced to 2021 and a parallel outcome has not been observed. This time round, the velocity of money has not collapsed, with the more recent perpetrator of rising inflation levels being predominantly cost-push pressures. Measures to mitigate the spread of the pandemic have made doing business more expensive, and the faster than expected recovery has led to some key shortages. Chip shortages have impacted many key industrial sectors. A global shortage of truck drivers and containers has hit logistics, and more recent gas shortages have impacted a number of core sectors across Europe. The rise in inflation itself has not come as a surprise, given the unprecedented monetary stimulus. Index-linked investments were already pricing this in, and they look expensive. At the start of 2021, the debate was focused on whether the uptick in inflation would be transitory or more entrenched. The consensus tended towards a more short-term trend. Since then, the pre-mentioned shortages in key areas have adjusted that transitory picture slightly. Previously super efficient, just-in-time global supply chains are unlikely to return in the same capacity. They will be replaced by more resilient and local supply chains, but with an obvious cost premium for closer-to-home operations. Whilst this will be a social and environmental positive, it will not happen overnight, and inflation remains a short-term risk, which may persist longer than expected. Supply chain constraints are now featuring in company reports, We will not be surprised if there is a subsequent impact on earnings for a number of companies in October and November this year. This is a truly global issue as business models are challenged and pushed to redesign. Whilst this might lend itself as more positive for some and negative for others, we suspect it to become a more homogeneous feature of reports and outlooks. Although we use the term post-COVID world, we're not expecting an eradication of the virus, but rather anticipating a world that is adapted. There are two things we forecast to impact markets. The first is around expectations. The reflation trade that depends on higher levels of mobility and consumption is looking vulnerable. In the first instance, to any new variants, but also to longer-term trend changes. This will continue to be a swing factor over the next year, although expectations for the recovery are already high. There's still a large degree of uncertainty surrounding how the world of work will look and how people will behave in a year's time. The second impact is around the political fallout of shortages, as well as European elections and tensions in Asia. The gas crisis is already straining relations within the EU. Alongside this, the recent German elections and next year's French presidential elections are reminding us of how divided society is. The German election drew attention for their movement away from the status quo. This was due to a narrow win by the SPD party. We're anticipating the formation of a government to be quicker than expected by the media, the SPD likely to form a coalition with the FDP and Greens. This would likely lean itself to a government that is slightly harder on Europe, but without the possibility of them leaving. Meanwhile, the Greens will bring the focus on to environmental projects, which is an obvious plus. From an environmental perspective, COP26 should provide an opportunity for faster action, but maybe also disappoint. We expect a great deal of noise in the next quarter. We've been running fixed income at a lower level for some time, and we've been more exposed to lower risk floating rate notes, which do not carry the interest risk. We've utilised the recent weakness in fixed income to add some high coupon paper for income and risk purposes. In bespoke portfolios, where we have the choice of underlying investments, we continue to prefer fixed income paper that cannot be accessed through equities, such as IFIM, the immunisation bonds, or Network Rail or the cooperative. Our property exposure has been focused on quality rental homes, social housing, medical property and homeless housing. During the quarter, we cut our exposure to medical property on valuation grounds and added exposure to homeless housing. In social housing, there has been an issue with investment. Although this is one that we do not hold, it has impacted the whole sector. The need for quality housing in the UK remains paramount, and although this sector is interest rate sensitive, we feel it has been priced in adequately. This quarter has proved mixed for renewable energy infrastructure assets. The summer was not great for either wind or solar, especially in the UK and Europe, but we have seen wind improve in recent weeks. Battery storage and AD continue to do well. We see energy yieldcos as a reliable defensive investment for the coming quarter due to their longer-term contracts that give sight over future earnings, many of which are linked to inflation. In terms of equities, much will depend on the specific sector and how the recovery continues. At the moment, there are a few perceived bubbles developing, and expectations do remain high. We remain particularly vigilant heading into the quarterly and second half earnings season. Higher input costs may impact margins, but could be offset by higher demand or prices. We see both opportunities and risks in the fourth quarter. The main risk might be a decline in all asset classes, the worst case scenario being an expected tighter monetary policy driving down fixed income, coupled with peak growth and lower profit expectations driving down equities. The fact that equity market returns have been much more subdued in the last quarter, after 6 straight quarters, accurately reflects the current position as well as underlying uncertainties. Fiscal support will need to end in almost all countries. The UK has finished its furlough programme and announced higher employment taxes, and the US budget is being hotly debated. Of far more concern to the markets are changes in monetary policy, both in terms of ending QE as well as rising interest rates. We perceive a slight possibility of an interest rate rise in the UK, as well as an end to QE in the next quarter. If so, we expect it to be well received as a start towards normality, as long as it is clearly flagged. In the UK and the US, comments are now being made by central banks to manage expectations, with markets listening intently. Fixed income assets have already declined in expectation of tighter monetary policy in the quarters ahead. There is increasing tension between impatience, as perceived bubbles begin to build, and caution not to act too fast and create another downturn. Sometime this quarter, this will need to be addressed, especially with the Evergrande debt crisis in China providing a timely reminder about the consequences of delaying action on asset bubbles. Whilst this is a tough period with a lot of potential hurdles, many of the dangers are out in the open. It will therefore be a process of navigating through the shortages, inflation, and uncertainty. The need for better infrastructure, more digital healthcare, renewable energy, clean mobility, good housing, sustainable finance, and food remains strong. Thank you for listening to the Quarterly 3 Fund Manager Report. Head to www.kingandshaxtonethical.co.uk for the latest news and views.